Good evening once again, and welcome to today's edition of our studies. Today, we are going to be continuing with what we began last week, which is the valuation fundamentals. So last week, we went through the basics of valuation, the rationale behind the concept of valuation. And basically, when we say we are valuing a company, why do we intend to do that? What does it mean to value a company and all of that? And we also glanced through the various models and approaches that is widely used or accepted in valuing or finding the enterprise value of a company. So today being the second session, we are going to be looking at practically the comparable company analysis, or simply put, the comps analysis. That is basically the valuation approach where you try to derive the value or the enterprise value of a company from a similar company, right? So quickly, let's get in, right? So when we talk about the comps analysis, like I said, you are trying to derive the value of a company from its relative similar companies or companies that are similar to that company, right? You are trying to glean insight from similar companies and use it to value the company in question. Now, with this one, like I have mentioned, it requires that you select a couple of companies that are similar to the company that you want to value, right? So there are a number of factors that you can consider to select similar companies. And it borders around quite a number of things. So first of all, if you are selecting a similar company or a comparable company, you look at the business activity. Their core business mandate, right? So this, in broader sense, you can say whether they are similar in terms of from the same industry, or probably they are similar in terms of what they do, their core business. And so, for instance, if you want to value a bank, right, a commercial bank, for instance, you'd want to look for a company or a bank that is also a commercial bank, right? You can't just go and pick a savings and loans or a microfinance for a commercial bank. That will not be a perfect comparable. Another thing you would want to consider is geographical location. So if you are valuing the company in Ghana, right, the best possible comps are similar companies in Ghana, and probably you might look at Africa. But for instance, when you are valuing a company in Ghana, and then you are picking comps way offshore, way outside Ghana, then that might not be a best fit for it. So we look at the location as part of the factors to select a comps. The third thing is the size and the group profile of the company. So you look at the size of the business, right? Is it a 5-branch business, or is it a 3-branch business? If it's a bank, for instance, is it a 1 million customer customer base bank, or is it a 10,000 customer base? You might want to look at all of that, as well as their growth profiles. The next thing is also you might want to look at their profitability profiles, and this borders around choosing the companies based on similarity with their profitability. So for instance, if you are valuing a company with a bottom line or a profit after tax of somewhat 500 million Ghana cedis, you might want to settle on comparables or companies that also project or produces similar profitability, right? So maybe you might create a range around plus or minus 200 million from the 500 million. Another thing is also the accounting policy, right? You want to make sure that the reporting standard is almost the same. similar or the same, right? And the last thing is the capital structure. If you are valuing a company with 100% equity, you might want to be ensure that the similar companies you be selecting will have 100% equity or up to 80% equity, or if it is 50 debt, 50 equity, you might want to know that you might want to settle on a comp or a similar company with such a capital structure. So the advantage of employing the comparable approach is that, first of all, people would be, naturally, they'll be willing to pay the price of for a particular company if they see that, okay, if they know the price of a similar firm. I mean, for instance, if you know that GCB Bank, which is similar to EcoBank, is selling at 30 cedis per share, practically you might want to pay something close to 30 cedis to EcoBank, right? So that's the rationale. Another thing is that for most companies, there are a variety of comparable companies or competitors. So for instance, if you want a bank, even locally, there are 23 commercial banks. If you want a bank unlisted on the market, there are 8 commercial banks listed on the market. So you always have companies to settle on as comps. And the last thing is that it's not that complex. It is easy to use and all of that. So, but the disadvantage is that there are not 100% companies which are the same. Like, they are not perfect comparable. But that's it. There are not perfect comparables. And so, definitely you have to create a room for margin of error. And the second thing is that you might fall into the either overvalue or undervalue trap, because the companies you are going to be selecting may be overvalued or undervalued. And that would mean that if it is overvalued, you might end up estimating an overvalued amount for the company in question that you are going to be valuing. So these are the advantages or the pros or the cons or the disadvantages of using the comparable company analysis. So in practice, sometimes one would say that if you can have up to 5 or 7, comparables, then you can be able to arrive at a result or evaluation amount with a less or little margin of error. So today's session promised to be practical, and exactly that's what we are going to be doing. So I wanted to give you a background of the cons, just as we discussed the other time. And as simple as that, we are going to be moving to our Excel, right? So quickly, I'll turn on to our Excel sheet and we'll start working. Right, so I believe that my sheet is very clear to all of you. So I have here a banking sector comps for us to consider. So that will be our case for tonight. Now, I'm trying to value Access Bank PLC, which is a company trading publicly on the Ghana Stock Exchange, currently at 4.80 Ghana cedi per share, with a year-to-date price gain of about 41%. Now, for Access Bank, because it is a commercial bank with also a Tier 1 capital base unimpaired, expected to be above a minimum capital adequacy level of 13%. I settled on 7 comparables from the market. So all these companies listed here are actually companies that are also on the market, trading publicly day after day. So for the sake of Access Bank being a commercial bank, being a bank and also being a bank regulated by the Bank of Ghana. And so here I'm considering two factors: the industry type and the business model, the business type. And I'm also considering the location, right? So I'm considering the fact that it is a bank, and I'm considering the fact that it is in Ghana. So that is why I've settled on these banks in Ghana as comps for Access Bank PLC. So we have ADB Bank, Agricultural Development Bank, we have Cow Bank, we have Eco Bank Ghana, we have GCB Bank, we have Republic Bank Ghana, and then we have Standard or Standard Chartered Bank. And then we have Societe Generale Ghana Limited. So on the market, we are looking at, before we continue, I want to issue this disclaimer that whatever numbers we'll be working with here or whatever we'll be discussing in this video is actually not an investment recommendation or an investment advice, and that whoever would chance on this video anywhere may have to do a thorough research or contact the expertise of financial advisory, right? Yeah, so that whatever we are discussing here, some are hypothetical numbers and they are not real-time and up-to-date information. And so it is not an investment advice. Thank you. So we are back to our screen. We are trying to value Access Bank with the comparable company approach. Now we have ADB, the price at 5.6 pesos. We have Cow Bank at 0.35 Ghana cedis or 35 pesos. We have Eco Bank at 6.10 pesos. We have GCB at 5.55 pesos. Republic Bank at 0.48 or 48 pesos. Then we have Standard at 19.25 pesos. And Societe Generale at 1.54 pesos. Now, the shares outstanding for these companies are equally listed below, between 709 million and 134 million among the 7 comparables that I selected. So we can calculate quickly a market cap, right? So you know market cap computation is just calculating our market cap, which is the share price multiplied by the shares outstanding, right? And that gives us the market capitalization of all these stocks. Now, the next thing we have to compute under market data is the net debt. Now, the net debt is actually the total debt minus cash and cash equivalent. And so if I scroll right, I have here a debt figure and I have a cash figure. I have a cash figure for each of the companies. So the net debt is actually the debt minus the cash, right? The total debt minus cash and cash equivalent. And I can just draw it down and then we can have a net debt figure. The next thing, which also needs computation, is the enterprise value, the overall value of the business, which is equal to the market capitalization plus the net debt, right? The market capitalization plus the net debt. So in any case, it can be the market capitalization plus debt minus cash, right? So we can also draw that, and then we will have 7 billion. These figures are already in millions. So 7 billion for ADB, 1.8 billion for Cow Bank, 1.9 billion for EcoBank, 2.4 billion for GCB, 497 billion for Republic, 3.87 billion for Standard, and 1.7 billion as enterprise value. Now, when you come to the financial data, we are sampling the sales or revenue. We are sampling the EBITDA, earnings before interest, tax, depreciation, and amortization. We are sampling the profit after tax or earnings. We are sampling the book value or equity or shareholders' funds. So we have 458 million in revenue for ADB. It's 21, 355, 3.5 billion, 3.7 billion, 5.3 billion, 1.55 billion. Like, once again, these are hypothetical figures. Now for EBITDA, we have also the respective figures already computed. Now, these ones are actually calculated from their financials, or they can be gotten from their financial statement. And so you just need to get them and then input it in your model, including the earnings, which is also profit after tax, and including the book value or the shareholders' funds or equity value. Now, here is our valuation. We want to value it by EV to revenue, EV EBITDA, and price to earning and price to book. Now, the first two is an EV valuation, enterprise value valuation, and the second side of it, PEPB, is an equity valuation. Now, the reason is that here, cost of capital is adjusted, and here cost of capital is not adjusted. I mean the EV, and then the PE here, cost of capital is already adjusted. So pre and post cost of capital. So EV to sales, simply enterprise value divided by sales. Then we can have it. Now, EV to EBITDA, we have our enterprise value by our EBITDA. Now, now we are on price per earnings. So the price of the company, which is overall the market capitalization, the market price. So here, since we are dealing in the market value, we want to use the market capitalization divided by the earnings, which is the profit after tax. And then here we have the price to book, which is the market capitalization divided by the book value or equity. So at the end of the day, control down, we've been able to compute for all our valuation multiples for all 7 companies that we are valuing. Now, we want to find the averages of these amounts. We want to find the averages of this amount. That is the next step. So the average of average of these. So we have the average, as well as we want to find the median, MED. So the median of it. So Control R, we scroll right, and then we draw right, and then we've been able to compute our average EM multiple for all the comparable variables. Now, a quick analysis here. If we, this EV to sales and EV to EBITDA are equity value multiples. Now, if we have the average of all the similar companies of Access Bank, right? We have the average multiple, which means that if we have the revenue or the sales of Access Bank, we can be able to generate a relative value for Access Bank, having the average of the multiple, either using the average or the median. So this time we want to go for average. We want to be too conservative. So for our valuation schedule down here for Access Bank, first of all, we want to value Access Bank's enterprise value, which is EV. We want to value Access Bank's enterprise value. So which means that having the EV by sales multiple, once we can have Access Bank's sales or revenue, right? We can be able to generate an enterprise value, a relative enterprise value for Access Bank by multiplying Access Bank sales to the average industry or comparable EV sales EBITDA, right? I hope this is very clear to all of us. Now, that is EV to sales. Now, the second thing is that since we also have the EV EBITDA of comparable companies, then we can be able to generate an enterprise value for Access Bank by multiplying the EBITDA by the EV EBITDA multiple. So now we have enterprise value for Access Bank PLC, right? Trying to scroll it for you to see it clearly. So we have enterprise value for Access Bank relative generated from the comms average EV to sales and EV EBITDA multiples. Now, the second part of our computation, which is the PE and PB, which I said has been adjusted for cost of capital or cost of financing, which is an equity valuation. Now, when we come here, the equity valuation, we can be able to multiply the earnings, right? Since we can be able to multiply, since we have the price to earnings, we can be able to multiply the earnings of Access Bank PLC by the price average industry price per earnings ratio, and you will generate an equity value for Access Bank, right? Clear, just as we did for the EV EBITDA. Another thing is that since we have the price to book, which average price to book, so we are trying to say that averagely industry price to book is around 0.59. So average price to book, which means that we can multiply Access Bank's book value by the industry average book value ratio and get a value for Access Bank PLC. So we have an enterprise value, we have an equity value. So here we want to calculate a share price, an equity market, an intrinsic value for Access Bank at the enterprise level. So at the enterprise level, we know that we have an enterprise value of 1.8 billion cedis. Now, when we come here, trying to find the price from the enterprise value, we know the equity value is the same as the enterprise value minus the net debt, because we calculated the enterprise value as equity value plus net debt. So having an enterprise value from our computation, if we subtract it from the net debt of Access Bank PLC, what we will get is an equity value, right? What we'll get is an equity value. So that equity value divided by the shares outstanding of, so divided by the shares outstanding of Access Bank, then we can have an equity value per share, right? So this is the equity value of Access Bank, which is currently Access Bank has a net debt of 8.4 billion and an EV. So if we subtract the net debt from the EV, we can be able to get an equity value. And from the equity value, we can generate the price per share by dividing the equity value by the number of shares outstanding. Now, the second one is we can be able to, similar to that, we can be able to generate from the enterprise value we earlier calculated, and then generate an equity value by subtracting the enterprise value by the EV EBITDA minus the debt, subtracting the debt from the enterprise value and getting an equity value of this. And from the equity value divided by shares outstanding, we get equity value per share. So at the EV sales model, we got in 5.76 Ghana cedis per share. At the EV/EBITDA model, we are getting 10.4 cedis Ghana cedis per share. Now, let's go to post capital cost adjustment, which is after cost of capital has been adjusted. Now here we have that the price. First of all, we computed that the enterprise value is, we first of all computed that the enterprise value is the, for instance, for the price is the book value times the average multiple. The same here, the enterprise value will be equal to the earnings times the average price per earning multiple. So since we have the enterprise value, right, subtracting it from debt, now we can be able to compute an equity value per share by dividing it by the shares outstanding. So at the end of the day, we are generating 4 separate valuation figures for Access Bank and finding the average of it. So finding the average of all the 4, we get a fair value of Access Bank at 3.8. So finding the average of it, we get a fair value at 6.76 pesos. So at the end of the day, by EV per sales, EBITDA, PB, and PE multiple, we are generating an average relative value of 6.76 pesos per share for Access Bank PLC. So now, after your valuation, you look at whether or not it's overvalued or undervalued by fair value comparison. So on the market, I think Access Bank is now selling at 4.80 pesos, 80 pesos. So which means that this is showing an undervaluation of approximately 40.93 or 41%. So this is basically the comps. We've tried to calculate the fair price of Access Bank by using the average multiples of similar companies on the market. So here we used ADB, Bank, EcoBank, GCB Bank, Republic Bank, StanChart, and Societe Generale. So your task is that the earlier comp schedule I asked you to build, try and compute a similar thing for your selected company. And then if you are encountering any issues, just let me know. Just let me know. And I will assist you in whatever you need to be assisted. So this will be the end of our lecture. Just 30 minutes, 32 minutes. And I'm glad you made time to watch this video. Till we meet again in our next section, where we'll be looking at cash flow projections and analysis to kind of build a discounted cash flow model. So till we meet again, my name is Udume Benizayao, and I'm privileged to be your resource person for tonight's session. Thank you so much.